Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com.
Dan, welcome back. We've got another edition of our Lockshield Partners podcast today. And today we're going to talk about diversification again. I know we've done that before, but a little bit differently today.
Yeah, today we're going to not talk about investment diversification, but net worth diversification.
I think it's an important concept because I think most people, when they think of diversification, they think of what we've talked about on our podcast before, which is stocks or bonds or U.S. or international or whatever.
Right.
But how would you define net worth diversification?
Sure.
Let's start there.
Yeah. So to your point, Clark, about investment diversification, stocks, bonds, what kind of stocks do you have? Net worth diversifications, we're just talking about different kinds of asset classes, which asset class is just kind of a fancy word for example, investments would be an asset class. Real estate is an asset class. Business is an asset class.
Owning a business,
having a business interest. That's exactly right. So in a world of unlimited time and resources, of which neither you nor I live in, it would be wonderful to have lots of all of those.
Right.
Each one has their own unique advantages and disadvantages, pros and cons, tax impact, liquidity, growth, risk. But it's nice to have, just like you would have a diversified investment portfolio, it's nice to have a diversified balance sheet or diversified net worth.
I think the biggest thing, Dan, that you and I see with clients is flexibility. If you have different asset classes on your balance sheet, maybe one year you take income from your retirement assets. Maybe the next year you're taking income from your rental portfolio or whatever the case may be. It's really nice to have that type of flexibility.
From a planning point of view, absolutely. So you touched on a couple of the major ones. You want to dig in a little bit on some of those main asset classes?
Sure. Yeah, let's start with what would probably be considered the most typical, which would be just your regular invested portfolio.
Whether it's a Roth IRA or 401k or whatever it might be.
Yeah, some mix of invested assets that people have built up over time. And as we've talked about before, even within that bucket, there's a level of diversification to achieve. You've got retirement accounts, Roth, pre-tax. You've got non-retirement accounts, which is essentially a bank account that's invested. It's liquid and flexible.
Right.
So even within that one spectrum, there's a lot of different types of accounts that we could have.
Sure. And some people have most of their net worth in that.
A lot of people probably do.
A large percentage.
Over time, what we've learned is the stock market's a pretty good place to invest your money.
Over time, that's exactly right. And it's passive.
Right. It doesn't require hours.
Unless you want to give it hours.
Right.
Which again, it doesn't require hours.
Which statistically probably doesn't help you anyway.
That's right.
But let's talk about maybe some of the pros and cons there. So the benefits would be, like you said, it's passive.
You're investing in someone else's business.
Right. Long term, the returns should work out really well in your favor. It's liquid.
There's tax benefits to benefits of Roth or tax deferred or whatever it might be.
Downside is we know at times it will be volatile.
You don't have complete control over it.
Right.
That's exactly right. So let's add another piece of the pie chart, which is real estate. And for most people, their home is a large part of that. And then what we see with a lot of clients is rental property. And so let's dig into that. You want to take that one as far as real estate from a financial planning point of view and net worth diversification point of view?
Sure. And I think when it comes to really building when it comes to real estate, there's a pretty big distinction between owning a property for investment purposes and it being your residence.
Sure, absolutely. Different objectives.
It's a much different objective. I think long term, we would look at that and say it's a great goal to have the mortgage on your primary residence paid off. But in a lot of ways, that house is not going to be an income source for you.
Correct. that's exactly right. It's not going to be.
It's really not an investment.
It's an asset. Your kids will
Right.
appreciate it,
Right. Now,
possibly.
maybe it's an investment if you decide down the road in retirement to sell it and
Sure.
rent.
Yep.
And you can use the
Or
proceeds
downsize.
or whatever. So in that case, it certainly can be, but
Right.
that's much different than purchasing a rental home or a duplex or a apartment
Warehouse or whatever it might
complex
be.
or piece of land or whatever the case may be. And when it comes to rental property, so let's maybe focus on that side. One benefit is, for the most part, someone else is paying to increase your net worth. The
Yep.
rent income or the lease income that you receive should pay down the principal balance on the mortgage that you likely owe on that. The tax benefit of depreciation can be really, really handy.
Right.
And you also get to participate just in general appreciation of the property value over time. So your net worth is really growing in a couple different ways there. The downside is that it's not as passive. It
Right.
probably requires more time and energy than your stock portfolio does, but you can be pretty passive in real estate too.
You can outsource that to a property manager.
Right. And everybody's heard horror stories about bad tenants.
Because they're out there.
There's a lot of them out there.
That's a real risk. So those are all things that you weigh.
Right.
I think in an ideal financial planning point of view, especially when we talk about income, and as you and I we've done a podcast on withdrawal rate. 4% withdrawal rate on $1 million is $40,000 a year, whereas that may be the same income off of 4 or 5 rental properties.
Right.
And your likelihood of increasing the rent over time, it's a different asset class, different risks, different rewards.
It is. It is. Now, another downside to real estate, it's really not liquid.
Not liquid at all.
You can't go to the bank and say, "Hey, I own this $200,000 house outright. I want to withdraw that $200,000."
Right.
There's ways
to do
equity, but
yeah, you can't sell off 8 shingles for $800.
Doesn't work that way.
Yeah, no, it doesn't work that way. So one thing that we see with our friends who are in real estate, whether it's realtors or builders, contractors, is they tend to have a lot of their net worth in real estate, which is not a bad long-term thing, but especially for people who are concentrated, and I would say the same thing for people in the investment business, who maybe they have a lot, their 401k, their Roth IRAs, but also their income is based on the investment world, just like realtors, people in real estate, their income is based on the real estate world. I would say it's really important for them to consider diversifying.
No doubt.
Absolutely. Let's touch on a third area, which is so in a perfect world, it would be great to have real estate and investments, 2 very different asset classes. And the one overarching theme that I'd say here, Clark, is it really, I don't say you have to, but intentionality.
Yeah. And I think before we jump on to business ownership, Dan, I think it's important to note that I think the average household with intentionality can do both of those things. You can have
I would agree.
You can have a good savings rate for your long-term retirement assets and slowly over time build up a portfolio of real estate, whether
Sure.
it's on your own or with a partner or whatever. But that is an achievable goal.
It's not out of reach.
Right.
If you're saving money, if you're saving 15, 20, 30 grand a year in 401ks and Roth IRAs, if you have a surplus, then for you to take 2, 3, 4 years to build up a down payment to buy your first home, and if you measure things in decades, not in years, okay, then when you turn 60, 65, you could have a portfolio of 3, 5, 7, 10, 20, whatever that number is, whatever your risk tolerance is, leverage,
Right.
all that. So it may not be common, but it's not to say that it's certainly not impossible or out of reach.
Right.
I think it's a good way to say it.
Right.
So let's touch on owning a business. There's a lot of people who have side hustles.
Mm-hmm.
Some side hustles are profitable.
Many are not.
But if you're intentionality, If you have decades and you are able to, and I think with the real estate and the investments come into play, it's easier to have those if you have a business interest that's kicking off income.
That
Now,
certainly helps.
it certainly helps. Now, one thing with business owners is, especially early on in the game, a lot of that money is reinvested back into the business.
Right. Right.
So in a perfect world, it would be great to have all of those, but that's not easy to do.
It's not. And when it comes to the business, I think the biggest benefits there are, if you look at appreciation, that's probably your best opportunity for, I don't want to say rapid net worth growth, but you should have a higher rate of return on your business than you do in the S&P 500 fund.
Invest in someone else's business.
Right. Or in your rental property. Those are great, 8, 9, 10% a year, but your business, you could do 15.
If that's your
20%
thing
a year.
and you're really good at it and committed to it, and you better love it.
Right.
Now it can complicate your finances. It can complicate your estate planning. It has some tax implications, both good and bad.
Right.
But I think a lot of people, especially young people today, they want to be a business owner.
What does that mean?
What exactly does that mean? Well, it means you work a whole lot for a lot of years to,
Right.
you work your whole life to be an overnight success, I think is one of my favorite sayings. So I think the bottom line is to kind of put a bow on this and land this one, to look long-term and realize to take advantage of the opportunities and like the Roth IRAs or your 401k or matching, but then also be looking also to start building that real estate portfolio or that business interest. And it's not going to happen overnight, but over the course of years, a decade, several decades, you can certainly get there.
Yeah. And I think if we're maybe assigning our listeners a couple to-dos or implementations that they can easily put into place, it can just be a very helpful exercise to write out your balance sheet. What do you currently own?
Yep.
What do you currently owe? Where do you feel excitement? Where do you feel a little nervous? Where do the cracks look like they are? That can be a good starting spot to say, here's what I need to, maybe here's the next area that I should focus on the balance sheet. And then it can be really helpful to have an accountability partner or a team that you review that with. And that's hard to be open and transparent
Sure.
and vulnerable with somebody like that. But I think it can be really beneficial to have someone to talk through that with.
For sure. And that's something that we look at with our clients, which is, when you look at their net worth from a pie chart point of view, if there's one dominant color on that pie chart, doesn't mean it's bad. It just means, hey, you have 85% of your net worth in
whatever,
a business interest, real estate, whatever
Right.
it might be. So,
right. Well, great. Well, Dan, thanks for joining us today. And if you have questions about net worth diversification, make sure to check us out at lockshieldpartners.com.